everyone. As you are filtering in here, I'll go ahead and give a quick introduction, go over some housekeeping items, and then we will go ahead and move forward with the webinar. Nexus, what next? It's been a little bit of time since we've done this one. We're really excited to present it to you today. But like I said, before we get started, let's go over some housekeeping items. So first and foremost, a few important things to note here. If you have questions, please reach out to us at any time. You can use the Q&A button and we will answer your questions at the end of this webinar or follow up with you via email. I will be sending out today's handouts and slides in the chat box. They'll be uploaded to Zoom and emailed to you tomorrow in 24 hours from this webinar. Also important, if you are here for CPE credit, you do have to answer the poll questions and the survey in order to receive CPE credit. So if you have any issues doing so, please let me know. I will help you sort it out and we'll get it taken care of. A couple other things that are important here. We have a few new additions to our Salt Vault. One of them, which is pre-recorded webinars. You can get CPE credit on your own time. We are slowly but surely adding more available to you, but there is a price associated with that. You can just purchase the pre-recorded webinars. You can purchase access to our Salt Vault. We have a list of some of the things that are inside of it. And reach out to me if you have questions. You can look on our website, but it is of great value. So let me know if you're interested. Take a look at our website. And yeah, and let's do some introductions here. So first of all, introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We would love to work with you and we would love to hear from you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well rounded and he has helped thousands of companies in all industries of all sizes and is especially well known for his work in the e-commerce industry. And Mike, if you want to take it from here, I'm a little rusty, but we got through it. We can go ahead and get started.
All right. Well, thank you very much, Ellie. Wonderful introduction. And we do have a lot of information to cover today. We're going to start with a quick definition of Nexus, but we're not going to get too deep into Nexus. We have a lot of other webinars where we go over Nexus. Today, what we're going to focus on primarily are what to do after you determine you have Nexus. So we're going to look at materiality, we're going to look at taxability, we're going to look at past exposure. We're going to look at how the states actually find you or your clients, and then we're going to talk about some options moving forward. And then very briefly at the end, talk about income tax, because you can have Nexus for sales tax as well as Nexus for income tax. And as always, we always like to bring this up. The worst time to find out that you have problems or the worst time to find out that your clients have problems is when they're being contacted by the state. That can come in the form of an email, a telephone call, them showing up on your doorstep. But the reason why this is the worst time is because now you're being reactive. And there are programs out there where you can mitigate past exposure, but those are off the table in most instances when the state has already contacted you. So in order to take advantage of a number of these programs, you've got to be proactive rather than reactive. And Ellie, why don't we go to the first poll question with that?
Absolutely. That poll question is being launched right now. The question is, do you or your clients already know where you or they have Nexus? Your choices here are what's Nexus, you've done some preliminary works, you have your Nexus footprint down, or you need some help. Mike, it looks like answers are really all over the board here and still rolling in. So why don't we give this a couple more seconds and then we can close it out and move forward.
Okay. Well, I see a couple people have answered what's Nexus. We're going to do a brief definition of Nexus. That's we're going to start off. All right. So Nexus is really just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection that must be present between you and the state before the state can require you to do anything. Before it can require you to collect its taxes, like a sales tax or a vendor's use tax, or pay its taxes, like an income tax, a franchise tax, or a consumer use tax, you have to have this link or connection, which we call Nexus. And that's why we say it all starts with Nexus. Because if you don't have this link or connection, then the state can't require you to do anything. So no Nexus equals no problems and no responsibility. Now, if you do have Nexus, it's not the end of the world. We're just going to look at some of the next steps, and maybe you'll have to get registered, maybe not. So, what should sellers do once they have Nexus? Well, they should register wherever they have the Nexus. If the potential exposure is material, what they sell is taxable, and a marketplace is not already collecting. Now, materiality is my comment. That's not something the states talk about. Most states believe you should register and start collecting tax from dollar number one, but I think that we need to use some common sense. You know, if the cost of compliance exceeds the back tax plus the penalty and interest, does it really make sense to file? And my answer to that is no. Just because a state says you should do something doesn't always mean that it makes good business sense to do so. I'm a big believer that, you know, we need to be registered if the impact is material. But again, if it's not material, we need to use some common sense. For example, if you're selling 200 items at $5 a piece, there are a number of states out there that say that you have Nexus and you need to register. Well, if you're selling 200 $5 items, that's $1,000. And the tax on that, let's say at 8%, that's going to be $80. And, you can't, even if you're doing this yourself, I mean, there's an opportunity cost. If you're hiring someone like us, you're not going to be able to get someone to register you for less than $80, and then you have to file the returns in a number of the states. Take Georgia, for instance. You're going to be a monthly filer for at least the first 6 months. So it's not just getting registered and getting the system in place to collect the taxes. Now you've got to do the returns. So in an instance like that, sometimes it's better off letting the state come and find you. You're going to be better off financially if you pay the state out of your own pocket, even if it's the back tax, the penalty, and interest. So we have to, determine what's material for ourselves. And the reason some people say, Mike, just tell me what's material. And that's going to be different for every firm that we work with. I'll give you an example. I use the Coca-Cola example a lot. $100,000 to Coca-Cola, that's a rounding error or rounding difference. Whereas $100,000 to me, that's a heck of a lot of money. So each of you or each of your clients needs to determine what's material for them. Now, in doing that, there are usually three things that our clients look at. One is risk tolerance. And there are some people who come to us and say, Mike, I can't sleep at night. I really think I hear footsteps. I think a state's going to find me. And if that's you, or if that's your clients, then maybe you use a much smaller threshold. Whereas we have other clients who say, well, Mike, nothing bad has ever happened to me in my life. I go to Vegas every weekend. I always win. Um, and if that's the case, then maybe you have a little bit of a bigger threshold. Your risk tolerance is greater. Um, Let me take a step backwards first. I can't tell you what is material, but I can generally tell you what's not material. And I can't ever make the math work if your taxable sales in a year are $3,000 or less. So that, for some of you or for some of your clients, in some states, that may be a big number. For some of you, it may be a small number, but I can't ever make the math work. Even at $5,000, it's hard to make the math work, but that's where most of our clients are going to start to say, okay, I've got to start considering to get registered. Below that number, not so much. So after we determine what the threshold is for us, we're going to look at what our risk tolerance is. And then we're going to move to profit margins. I mean, a lot of people tell me, well, Mike, I'm trying to build, some market share here. Right now I'm working at a 2% profit margin, or maybe you're not even making money. Maybe you're losing money. And this is a little bit counterproductive. So people say, well, when I get more profitable, I'm going to become compliant. Since the average sales tax rate out there is 8%, if you're working on a 2% profit margin, it's imperative that you protect yourself, because it's the smaller companies, it's the companies that can't afford to be compliant, or in their own minds think that they can't afford to be compliant, that they're going to get hurt the worst if a state does fine them. So if you have a 2% profit margin and the state rate is 8%, and then penalty and interest are another 50% when you add them together on top of that, you're looking at about 12%. So if a state finds you 3, 4, 5 years down the road, not only have you wiped out your profits in that one state, you may have put yourself out of business. And once one state contacts you, you'll probably be contacted by another 2 or 3 states within the next 6 months, because these states do talk to each other. So profit margins play a big part here. The lower your profit margin, the more important it becomes to use a lower personal threshold. The higher your profit margin, then you can afford to perhaps have a higher personal threshold. And I say personal threshold because, again, these are not the state thresholds. It's what you believe is material to you. And in capital reserves, if you've got a lot of money in the bank and, if something bad happens, you could easily cover that out of cash flow, then maybe you have a little bit of a bigger personal threshold. But if you're like most companies we work with, everything's going back into the business or paying bills or salaries, tied up in inventory. Again, you want to have a personal threshold that's a little bit smaller. So these are the 3 things that most companies look at when determining what's going to be material to them. Next thing we want to look at is taxability. So just summarizing on materiality, if it's material to you, I believe that we need to take action. If it's not material, then maybe we wait until it does become material. Next thing, taxability. Taxability can be very, very granular. That first picture, I'm originally from New York. Bagels are near and dear to my heart. First picture is just an unsliced bagel. The second picture, sliced bagel, maybe you're going to put a smear of cream cheese on there or something. And the first instance, not taxable. Second instance, once you cut it, put some cream cheese on there, that's going to be taxable. Tangible personal property in general, and tangible personal property is something that can be seen, felt, touched. It's perceptible to the senses. That's going to be taxable by default. And unless there's an exemption, and by the way, there's lots of exemptions out there, it's going to be taxable by default. And when you have exemptions, they can be by item. For example, groceries, can be exempt in a state. And if it's exempt for everybody, then you don't have to worry about certificates. It can be exempt by use or by entity or even by project. So by use, some examples would be buying something as a sale for resale, or buying something that's going to be used or consumed in the manufacturing process. Those are examples of things that are by use. And then by entity, local governments, nonprofits, they can sometimes buy on a tax exempt basis. And even projects, when we start talking about contractors, one project they do may be taxable, the next one may be exempt. So there are lots of exemptions, but in general, tangible personal property is going to be taxable by default. And that's in direct contrast to services. Services are generally not taxable by default, and they have to be specifically enumerated to become taxable. Sometimes this needs some digging, and it's really in the fine print. For example, in Texas, I like using website design or website hosting as examples. If you're looking at the big picture, if you're looking at the list of services that Texas say is taxable, you don't see website design or website hosting listed. However, they do say that data processing is a taxable service. And I don't think of data processing when I think of website design or website hosting, but there's long precedent here in Texas that Texas says that we consider website design and website hosting to be data processing. So if you're going very quickly and you see the big picture stuff and, website design and website hosting is not listed, we see this mistake being made a lot. Sometimes even some very smart accountants out there going back to their clients and say, no, you don't have to worry about the tax. It's not a listed service in Texas, but you got to dig deep. And you can't just stop at the big headline materials, because Texas for over 20 years has held that that is a taxable service under data processing. Also, some states tax most services. So Hawaii, New Mexico, South Dakota, and West Virginia, they're the exact opposite. They're going to, treat services like tangible personal property, and it's taxable unless it's specifically enumerated. And by the way, whenever I'm saying this, if I say services have to be specifically enumerated and they're generally not taxable by default, there's someone in the audience who always says, well, Mike, there's no services that are taxable in my state. And I just want to say this: every year, states tax more and more services. And I don't know of a state out there that has a sales tax that doesn't tax at least some services. It's one of the areas that trip people up the most. Sometimes a non-taxable service will become taxable when it's being sold in conjunction with tangible personal property. California used to have a great example on their website. It was about drapes. And, if you are going to get drapes for your bedroom and you go in and then you take some measurements and You go down to the local store and you're going to buy these drapes and you give them the measurements and they have them, altered. Um, that's going to be a taxable service because it's associated with the sale of tangible personal property. And by the way, California taxes very few services. They mostly tax tangible personal property, but since this is being sold in conjunction with the tangible personal property, it becomes a taxable service. Now, let's say I take those drapes home and I hang them in the bedroom. I absolutely hate it. I sleep on it and I figure out I've got to change this. So I decide I'm going to put them in the game room instead. And I go and I measure at the game room. I go down to the local tailors or dry cleaners, whoever's doing alterations in your area, and you say, I need to get these altered. And because this is now no longer associated with the sale of tangible personal property, that same exact service that the day before was taxable is no longer taxable. So it can get very, very granular very quickly. And states look at what you sell through the prism of what they tax. So they do a lot of stretching. So it's may not always be obvious on the surface, and that's why you got to do the digging. Now, here's some research do's and don'ts. A lot of people tell me, Mike, well, I just call the state, and the state tells me what to do, and we're going to touch on that here in a bit. But number one, don't try to stretch what the state says to fit your circumstances. The states are going to do that, but you don't want to do that. You don't want to say, well, this is exempt because it's sort of like this over here. You don't want to stretch. You want to fit firmly in the middle of the box there. You don't want to call a state and accept verbal guidance. I mean, you can call a state 5 times in a row and get 5 different answers. And when an auditor comes out, they're not going to accept any verbal guidance that you got. They're going to say, did you get it in writing? So you can't just call a state and accept whatever they're telling you on the phone. Now, if you do call the state, ask them if they can point you to any type of written documentation. Is there any publication that they have that can document it? And you may not want to offend the person you're talking to, so you can say, hey, this is great. Thank you for this information, but my boss is going to want something in writing. Is there someplace you can steer me, or can you send me an email documenting everything that you just told me? Generally, they're not going to document it in an email, but they might be able to point you to some sort of documentation or publication or something that is going to explain what they're doing. Now, when they point you to it, make sure you read it, because a lot of times when I'm reading what they point me to, it says the exact opposite of what they're telling me. So just because someone points you to a publication, don't assume that they've interpreted that publication correctly. Another thing about assuming, you can't assume the competition is doing it correctly. Sometimes a whole industry will be targeted by a state because the state knows the whole industry is doing it incorrectly. I've got an example. There's this company, they were leasing camera equipment, and they were leasing it all across the country. And it was, the type of equipment that you would use to film commercials. So one of the states, Massachusetts, audits this company or audits a customer of this company, and they see that they're leasing camera equipment, and they call this company up, and the company says, well, no, we don't need to collect tax on that. No one in our industry collects tax like on an item like that. And they have Nexus because they own tangible personal property in that state, which creates that link or connection. And the state says, well, yeah, this does create Nexus, number one, but number two, it's taxable in our state. So if you give us the names of all of your competitors, then we'll make sure that they start doing it correctly also. And the way we found out about this is one of their competitors called us and said, "Can you believe that one of our competitors turned us in? And oh, by the way, is this correct?" And unfortunately, we had to tell them it is correct, and it's correct in most states. So we had to do a big project for them and get them compliant in all the states out there. We did a combination of voluntary disclosure agreements, and they were in compliance once we completed the project for them. But the reason I'm talking about that is we can't assume the competition is doing it correctly. And just because a company is large and may have a big internal tax department still doesn't mean that they may be doing it correctly. I mean, I've been on the phone representing our clients when some really big name companies out there and they just got it wrong. And after the telephone call, um, sometimes we get a call from the big company saying, "Hey, thanks for that information." But you can't assume the competition is doing it right. Don't play follow the leader. I mean, this is your business. It can have huge implications if you get it wrong. You got to go out and you got to do the research, or you got to have someone do the research for you. You can't rely on an article. Articles are great in that they can alert you to an issue, but you don't know if the person who wrote the article interpreted this correctly. You don't know if the article has been superseded since it's been published. So we can't just rely on articles. We can use articles to alert us to issues, but then we got to go and do the research or hire someone to do the research. Same thing with a chart. I mean, a lot of people ask us for charts. You got a pre-printed chart? I always say you can't rely on a chart for final answers. Again, they're a great tool. They can alert you to a possible issue, but you don't want to base your final strategy on a chart because you got to fit the middle of that box. I mean, charts are based on a specific set of facts, specific set of facts and circumstances, and you may not fit those. I'll give you a case in point. We were hired by a company that was out of the UK, and they were selling software as a service here in the United States. And they wanted a chart to see if software as a service was taxable. And software as a service is going to be taxable in about 20 states. And I said, convince them, our salesperson convinced them that, hey, there's a lot more to this than just getting a chart. You don't want to base any final decisions. So whenever we're doing research, we ask to see a copy of an invoice, a copy of the agreement, and we ask them, our clients, to explain to us in their own words what they're actually selling. So in this instance, this person told us that in their description, the most important thing about our software is that you need to download it. And they gave us an agreement that was for downloaded software. So they were saying there was software as a service because once you download their software, you're going to remotely talk to their software. But a state's going to look at that as downloaded software, not software as a service, because you got a downloaded software agreement. You're physically downloading the software. So the downloadable software is taxable in a lot more states than software as a service. So you can't just rely on a chart. I can give you example after example of someone who and it works the other way. Someone else who wanted to get registered, they had a chart from someone, they wanted to get registered everywhere that software as a service was taxable. But they were using software to remotely access data. And remotely accessed data, if you're accessing your own data, that's generally not defined as software as a service in most states. So they ended up getting registered in 2 states rather than in the 20 states or so that tax software as a service. So again, a chart is a good place to start, but it can't be uh, uh, use a chart for your final answers. Same thing on a frequently asked questions page. You can't just go to a website. It's not an authoritative source. It's too easy to change. Give you another example. We had a client who told us, "Oh, Mike, I want to get deregistered in the state of Texas." And I asked them, "Well, how come?" And they said, "Well, because according to their frequently asked questions page, I don't have to be registered." And I said, "Well, according to the statute, I think you do need to be registered. I don't think it's a good idea to get registered." And they said, "Well, I'm going to do what the state of Texas tells me. Please deregister me." And deregistration is a process. It's sometimes harder to get deregistered than it is to get registered. And we, did what our client wanted, and we got him deregistered. Well, about a month later, Texas came back and they corrected themselves. They fixed the frequently asked questions page, and they started pursuing people. And like I said, it's not authoritative, so you can't always say, "Well, it was on your page." Well, it's not there now. So our client came back to us and said, "Okay, guess I shouldn't have deregistered. Can you please get me registered again?" Which is another process. So you can't use a frequently asked questions page as an authoritative source. It's a great tool. It can point you in the right direction. It can be a red flag, but again, it can't be the final answer. You got to actually do the research or have someone do the research for you. Also, you can't blindly trust your accountant. Some accountants are very, very good, and they've got good state and local tax departments. And they do have the correct answers. But since Wayfair, it seems like just about everybody is a sales tax expert, and they're not. And the software companies out there go to these accountants and they say, "You too can be a software expert, excuse me, a sales tax expert. You just have to use our services." But they don't provide, just because they're going to file returns for you doesn't make you a sales tax expert. And you're getting, when you're dealing with these software companies, you're getting your answers from salespeople sometimes. And salespeople are great. They serve a purpose. Answering your tax questions should not be one of their purposes. So we see a lot of information being given out by accountants who just don't understand sales tax. So you can't blindly trust your accountant. You got to ask them, how do they keep current? Where do they get their information? How many sales tax clients do they have? How long have they been doing this? And like I said, there's a lot of them that are really good, but a lot of them are really new to sales tax. So not all answers from your accountants are equal. So um, going back to the charts, when you do have a chart, you got to read the underlying citations. That's part of the research there. Do your facts and circumstances actually fit the facts and circumstances that, this scenario that the chart is answering actually cover? There are lots of research sources out there. You've got CCH, BNA, Thomson Reuters, TTR. By the way, Avalara purchased TTR, and there are more. These are some of the ones we personally use: CCH, BNA, Thomson Reuters, but they're not cheap, and sometimes you may not have enough of a need to have one or more research sources. So then maybe it's better that you reach out and ask someone to do the research for you. But those are all great sources. We ourselves offer a source. We call it the Salt Vault. Lots of tools in there that you can utilize. And if you want more information on that, you can reach out to Ellie. Here are some economic thresholds for sales tax. Looks like this slide is out of order here. I apologize for that. This is a great time of year to actually be looking at this, though. So we said we weren't going to talk about Nexus, but I just want to bring this up. Look at Alabama. It says previous calendar year. So yeah, December's a time of year where we generally want to be reflecting on the previous year. We want to make sure we're doing things right going into the new year. So it's a natural time for people to be looking at what they may be required to do, or what they no longer have to do, or what they should start doing. But because of the way that states frame their look back periods, um, that makes it more important to do it this time of year. At least every December or January, you should be looking at your Nexus footprint. For example, Alabama, they say previous calendar year. So you got to look from January to December. And did you cross the threshold? And if you did, then you should take the next step. Are my sales material, and are they taxable? So and if they're not, if you don't need to get registered, then you wait another full year. You don't have to check it. It's only once a year because it's based on the previous calendar year. Alaska, on the other hand, this is what most states are. It's the previous calendar year or the current calendar year. So again, it's a good place to time of year to check that, because in December, we're going to look at the previous calendar year, which would run from January through December. But if your business is growing slowly, or at a normal growth rate, then maybe you don't wait until the following December to check on that also. But if your business is growing very quickly, maybe you do have to check it more frequently. I'll give you an example here. We had a company that ended up on Shark Tank, and their sales went up like 800%. So they had asked us to review their, where they needed to register on it going forward. And they were a fairly small company. They were only registered in like some less than 5 states. And when I checked it, they only gave us the previous year, and this was March, the end of March. So I told them they had to get registered in another 2 states. And the salesperson said, "No, Mike, their sales have gone up like 800%. You need to look at year-to-date sales." So they gave us the year-to-date sales. And when I looked at that, it was over 20 states they needed to be registered in, because that's how quickly their sales had grown. So if you have explosive growth, you need to, and it's a state that says previous or current calendar year, you need to check that more frequently as the year goes on. Ellie, why don't we go to the next polling question?
Absolutely. That should be on everyone's screen right now. Quick reminder, you do need to answer these questions in order to receive CPE credit. The question is, what about sales tax nexus concerns you the most? Your options are nothing, you have it down, economic nexus, third parties, or travel. And then there should be another option here, other, but it's not here today. Mike, it looks like most people are saying economic nexus and third parties. Let's give everyone a few more seconds to answer, and then we can move forward.
Okay. Well, let's talk about how states find you now before we go into some options on how to get registered going forward. So, and qualifying any past exposure. So one of the biggest ways, if you're selling on a business-to-business basis, is the states audit your customers. And when an auditor comes out, they're not just looking at your sales to make sure that you're charging tax everywhere you need to be, and that all the tax that you're collecting, you're actually remitting. They're also looking at your purchases, because just because you aren't charged tax on a purchase doesn't mean that it's tax-free. If it's a taxable transaction, you're supposed to self-assess that tax. and remitted to the state as a consumer use tax. So when an auditor is making sure that you're paying tax on these purchases where you need to, where you haven't paid it at the time of purchase, they're also using that as a lead source. And some states are very, very formal, like the state of Texas. A lead card needs to be filled out for each company that is not charging tax. Now, just because you are on a lead card or you're found in someone else's audit doesn't mean the end of the world. It just means you're on a list. And you may get called, or you may get a Nexus questionnaire right away, or it may be 6 weeks from now, or 6 months from now, or a year from now. But at some point, someone's going to follow up on this list. Competitors, I gave you the example earlier about the company renting the camera equipment. Your competitors can turn you in, and this is becoming a bigger issue because some companies are not compliant and they want to become compliant, but their competitors are not charging tax. And they ask us, Mike, how can I make my competitors do this? Can I tell on them? Can I turn them into the state? And unfortunately, the answer is yes. So states find us through our competitors, through our customers. Sometimes it's very innocent. If you're not charging tax, your customer may have to pay a use tax. They're not sure. They call up the state and they say, hey, my vendor didn't charge me sales tax. Do I need to pay use tax on this? And the state says, who's your vendor? Next thing you know, you're on a list. Vendors, they get audited, and sometimes you can end up on a lead, an audit lead list also that way. Some states are purchasing lead lists. Some states, go to Amazon, and Amazon gives them a list of everyone who has inventory in their state. Web surfing, some states do it manually. Some states have software programs called web crawlers that look for certain words that make it look like you're doing business in multiple states. If you're already registered, any type of red flag is an issue, like large exemptions. But we're talking about if you're not registered, how do the states find you? So each state has what's called a discovery unit. And the whole purpose of the discovery unit is to find taxpayers that aren't currently registered that the state believes that should be registered. So if the state does find you, in theory, they can go back to the date you first started doing business in the state. In practice, they routinely go back 7 to 10 years, depending on the state. They can go back further. And, Texas says they usually go back 7 years. I was involved in an audit where they were trying to go back 12 years because they thought that they could get away with it. Well, when we got involved, they went back to 7 years. Whether it be 7 years or 12 years or 10 years, I mean, that's a lot of time. And the penalty and interest can quickly exceed 50% of the actual tax that's owed. And the state's going to want back taxes, penalty, and interest. And a lot of people say, well, if the state fines me, I'll deal with them then. And they think that they can negotiate their way out of the penalty and interest and the back taxes for the entire period in question. Very, very limited. There are a couple of states that will allow you some sort of mitigation option, but by and large, those mitigation options, you got to be proactive in order to use them rather than reactive. All right. So let's say you've determined what your Nexus footprint is. You know where you have Nexus. You determine that your potential exposure is material. Your sales are taxable, and what you're selling is outside of a marketplace. Well, what should I do next? Well, you've got to determine what your past liability is, if any. You may not have any. But if you do, you want to know what that is before you determine how you want to move forward. So there's a couple of ways to do that. The three-step process is determine if there's a need to register, which we've already talked about. Number two is quantify the past liability and then determine the best path forward. And we're going to talk about some of the ways to move forward, but let's talk about how to determine past liability, if any. There's two ways to do this. One is a quick, rough estimate. And for a lot of, scenarios, this is, will get you in the ballpark and determine how you want to move forward. So you determine the first date of Nexus for each state. And then you determine the sales by state since that first date of Nexus. Then you're going to multiply the sales by 12%. How do I get to 12%? Well, I'm using an average sales tax rate of 8%. A lot of states are going to be lower. A lot of states are going to be higher. 8% is a good number. And then we're going to use a penalty and interest of 50%. So 50% of 12%, 8% is 4%. So 8 plus 4 is 12%. So that's going to get you in the ballpark. That'll let you know, oh my, I've got a lot of exposure. I probably don't want to just get registered and have to pay all of this back tax and penalty and interest. So maybe you'll want to do a voluntary voluntary disclosure agreement. So that's just a real ballpark number. The next way to do it is to try to get to actual numbers. And that's what we call an exposure review. And you can do that with or without a VDA benefit analysis. The first two steps are going to be the same, but then you're going to determine the actual tax penalty and interest rates. Then you're going to multiply the sales per year by the actual rates. You're going to determine the VDA look-back periods. Because some states, the VDA look-back period is 3 years, and some it's 5 years. And so you're going to determine what that is. And then you're going to redo the numbers using these VDA benefits and compare. Does it make sense for me to do a VDA? And when we start talking about VDAs, which are going to be in a second here, one of the biggest benefits of a VDA is they limit the look-back period. So if you're not registered, a state like California, they may go back 8 years, plus penalty and interest. I mean, that's a lot of money. Their VDA period is 36 months. So right away, you're saving 5 years of back tax, penalty, and interest. And then in that 36-month period, they're also going to waive their penalty. So these VDAs can be great tools. They're not one-size-fits-all tools, and you got to determine if it actually makes sense for you. But before you can do any of that, you got to determine what your past liability is. There are some software companies out there that say if you owe $500 or more in back taxes, then you need to do a VDA. And oh, by the way, our VDA costs $3,500. I don't know about you, but I think it's ludicrous. Why in the world would I want to pay someone $3,500 to remit $500 on my behalf? So you got to know what your past liability is. And, if you owe $60,000 and by doing a VDA, it's going to save you $20,000, well, that makes a whole lot more sense. But in the first instance, no. And we see people coming to us with, an invoice from, Avalara for, $70,000, $80,000, $90,000, and they owe $20,000 worth of tax. I mean, it's ludicrous. So you've got to know what your past liability is before you can determine what the best way to register is. So here's a number of ways to register. You can register prospectively, which just means you're going to register either with today's date or a date in the near future. And sometimes that's what you need to do. Maybe you just crossed a Nexus threshold. Or maybe you can't afford to do it the way the state wants you to do it, which is either historically or through a voluntary disclosure agreement, or maybe you want to roll the dice. There are some states where you can, states where you cannot. State of Illinois is going to audit everybody. The state of Wisconsin is going to audit everybody. The state of Maine has been auditing a lot of people. The state of South Dakota is going to question you during the registration process. So you can't do that everywhere, but there are a number of states who are going to take you at your word. So we have a lot of clients who just say, Mike, I understand this is not the correct way to do it, but I don't have the money to pay the back taxes at this point. I need to stop the bleeding. I need to stop this liability from continuing to get bigger, and they're going to register prospectively. The way the states want you to do this is register historically. And when you register historically, you can ask for a penalty waiver. And a lot of times states are going to give it to you. Registering historically just means whatever your date of nexus was when you were supposed to begin collecting tax, you get registered with that date. State's going to come back and say, thank you for registering. Now, please file all the back returns, and we want our penalty and interest. You can register through a voluntary disclosure agreement, or VDA. And we talked about the benefits of that being a limited look-back period and a waiver of penalty, and in limited instances, in limited states, an actual waiver of interest. You can register through an amnesty. Amnesties are few and far between. And then you can register and then ask for a managed audit. That's if you don't qualify for a VDA for whatever reason. So prospective registration issues, it's not the way that states want it done. If there is past exposure, the past exposure never goes away. So the state can, at any point, if they find you, they can always come back for those periods. States are getting very aggressive. We talked about those. We expect more states to follow. Now, the voluntary disclosure agreement, as a reward for stepping forward voluntarily, states are going to limit the look back period to 3 to 4 years. They're going to waive the penalty, and as I said, in a handful of states, waive or reduce the interest. And you may say, well, if a state can go back 8 years, why are they going to settle for 3 years? Because they don't have to find you. They're rewarding you for stepping forward voluntarily and volunteering to collect and remit their tax on a going forward basis. So it's to them, it's a win-win. VDA generally not available. There are exceptions, Michigan, Florida, but in general, once a state contacts you and they keep good records, they're going to, it's not going to be available. VDA, great tool, but like all tools, not for all scenarios. We were talking about that Avalara example. I mean, you got to make sure that you're at least saving as much money as the VDA is going to cost you. I mean, our VDAs are a lot cheaper than Avalara's. It depends on how many you're doing, but if, you know, we're at $2,400, which is one of our levels, you got to at least be saving $2,400. I mean, it doesn't matter who you're going with, whatever the cost of the VDA, you got to be saving at least that much money. Now, states are generally going to try to include income tax in a sales tax VDA unless it's prohibited by Public Law 86272. So you'll need to know that. All right. So why should a business care? Past exposure can absolutely destroy a business. The states are getting more aggressive. A lot of times someone will tell me, well, Mike, you know, I'll just bankrupt the company if the state comes after me. Well, in many states, the owners and officers can be held personally responsible for sales tax issues, even when the tax is not collected. And sales tax liabilities generally survive the closure of a business and even the bankruptcy of a business and or the owners. So that's why businesses should care. And why now? Well, economic nexus, the states are gearing up to track down sellers. I mean, we're 5 years into this at this point. States know that they are very low, 40 to 50% compliance rate, so that they know there's a lot of companies out there that are not compliant. And while the states are doing this, they're going to stumble across all types of nexus. So while 5 years of economic nexus is tough, what happens if you've had an independent contractor working on your behalf in a state for the last 10 years? Recessions, as we go into a recession, states historically need to make up that revenue, and they've increased the discovery efforts. So you already have the states gearing up because of this economic nexus, and people are worried about us, actually going into some type of recession here. So I'm looking at this as the perfect storm. So you really want to get out ahead of this. You want to take care of this proactively before the states are contacting you, and it's being done reactively. And Ellie, why don't we do the final polling question?
Absolutely, and that should be up on everyone's screen right now. Quick true or false question. Owners and officers of a company cannot be held personally liable. Mike, most people are answering false here. Let's give it a few more seconds, but quick reminder once again, you do have to answer these questions in order to receive CPE credit. And you will need to answer the survey at the end of this webinar as well. It should pop up for you automatically. It will also be emailed to you in 24 hours. So Mike, let's close this out and move forward.
Yeah, and the correct answer here is false. Owners and officers of a company can be held personally liable. You don't even have to have an ownership interest. And in some states, if you're involved in the sales tax collection process at all, you can be held personally liable. So the correct answer there is false. Income tax, we've been saying for the last couple of years that income tax is going to be the next big battle for e-commerce companies. Oregon right now, they introduced a gross receipts tax, which is not subject to Public Law 86-272. It's for companies that have, 750,000 to register, $1 million to actually file a return. So that's a fairly large number of sales in Oregon. But we're going to see more states do that. We're going to see Massachusetts says that Public Law 86-272 is unconstitutional. And by the way, Public Law 86-272 is a protection. It's a federal law. It was passed by Congress in 1959 that says that if your only activity in the state is the sales of tangible personal property and those orders are approved outside the state, and they're fulfilled from a point outside the state, then the state cannot impose a net income tax. In light of Wayfair, Massachusetts says that's unconstitutional, and they're going to look to bring some sort of case before the Supreme Court to get that challenge probably. The MTC, though, they provide guidance. That's the Multi-State Tax Commission, the quasi-governmental agency, actually the Multi-State Compact, which was formed the MTC. And they just virtually eviscerated their protections of Public Law 86-272. So anyone who is using cookies, anyone who's offering employment opportunities through their website, anyone who's using email or chat on a post-sale basis to offer customer service. So there's an all-out assault on this Public Law 86-272. And we're seeing a number of states adopt that. New York is just said that they're getting close to adopting it. New Jersey has adopted it. California has adopted it. So we see this accelerating over the next 2 years. Here are some of the very aggressive states right now: California, Pennsylvania, Florida. If you're a C Corp, if you're a pass-through entity, they don't have personal tax, so you don't have to worry about it. You've got Illinois, Puerto Rico, Nebraska, South Carolina, Texas, and Kentucky. This is not an exhaustive list, by the way, but these are some of the names we're seeing over and over again that are getting very aggressive when it comes to income tax. And Ellie, at this point, we have any questions?
We do not have any questions at this time. If you do have any, please use that Q&A button to send them. Mike, anything else you want to cover really quick before we close out here?
No, I just want to thank everyone for joining us today. And, as we go into the new year, we'll have a number of new webinars that we will be rolling out, as well as redoing some of the older webinars that we've offered. And I want to wish everyone happy holidays. So I hope that everyone has a great start to the new year, and see you all soon.